spike's going to fall over.
Tom, your response to that?
Well, I don't know. I'm not quite sure which currency the dollar is going to implode against. It certainly doesn't look like it's imploding against the yen or the euro. You know, at some point in the future, down the track, the unintended consequences of today's monetary policy may indeed come back to hurt investors through inflation, through some kind of currency crisis, through some kind of other debt crisis. But I think the issue is that in the interim, and I think that potential crisis, if it happens, is a considerable way down the track. In the interim, things are looking better. You know, the U.S. housing market is picking up. It's picking up from a very low point, for sure, but it's picking up. Equity markets have done reasonably well.
I think that's actually part of the problem.
Now, but it's looking better. And, you know, when things are looking better, gold goes down.
Peter, why is that part of the problem?
Because housing prices are still too high. We're still diverting too many resources to propping up the housing market. We should be building factories, not houses. The government is trying to reflate that bubble. This is just, you know, digging us into a deeper hole. But the recovery is an illusion. It's all built on a mountain of debt, and it's papered over by inflation. And when you talk about the dollar imploding, all currencies can go down simultaneously. It implodes relative to its absolute purchasing power. You need more dollars to buy oil. You need more dollars to buy food. But eventually, I think the dollar is going to lose a lot of value against other fiat currencies. You've got other currencies intervening now. They're trying to weaken their currency against the dollar. They're trying to prop the dollar up. Look at what's happening in New Zealand. Look what's happening in Norway. Look what's happening in Switzerland. And, of course, the yen wouldn't be weakening if the Japanese weren't talking it down. I mean, everybody is trying to weaken their currency to prop up the dollar. But eventually they're going to give up this foolish policy because the more money the world loans us, the deeper the problems get. They can't vendor finance us forever. Eventually they're going to have to stop doing it. And then the dollar is going to lose value even against, you know, other fiat currencies, even as all fiat currencies will lose value against gold based on this current race to the base.
Tom, your take on Peter's comments.
Well, look, you know, as I said at the start, we're not saying everything in the garden is rosy, and the U.S. undoubtedly has some serious structural issues to address in terms of tax, of spending, and there doesn't seem to be an easy way through that. But, you know, the economy is, for all of that, improving. You see that in factory output, you see that in hiring, you see that in business investment, and in that environment, whether Peter likes it or not, the number of large-scale investors like George Soros who feel they need to have a significant proportion of their money in tail-risk hedge assets like gold is diminishing.
All right, Tom, before I let you go, if gold is overvalued, as you say, then how far can it go? What's your price target for the end of the year?
Well, we don't specifically publish targets in that way, but when you're talking about where gold can go to in that kind of space of time, I think you have to remember that it was only 2 years ago that gold was trading at $1,400, and it was only at 5 years ago that it was at $650 an ounce. So, you know, if we do see by the middle of this year the Fed scaling back its QE, as has been discussed, then I think you've got to consider where gold goes back to relative to what's been happening over the market over the last 3 or 4 years.
Okay, our thanks to Tom Kendall of Credit Suisse. Now, Jim, you heard Tom. You also heard Peter. Strong arguments on both sides. They're making a fundamental case here. Who's right? How are you trading gold?
Well, the part that Tom's right about is that our currency and our long end of our treasury curve at some point in time may become non-desirable for the rest of the world, but at this point in time there doesn't seem to be much of an alternative, you know, particularly when you see 5, 6 other central banks more aggressively being combatants in this currency war. Now, mostly I agree with Peter, though, on the long-term trade of gold, and I think it's a great long-term investment, too. And I also think in the short term I like the trade as well, too. I think it's come too far too fast, and it's due for a little bit of a bounce. I'd be interested in buying gold at $15.78, which is right where it is now. But this is a short-term trade. I'm looking for $15.95 on the upside. If it goes down below $15.66, I throw in the towel and think it has more room to correct. I do think in the greater scheme of things that what we're seeing over the last couple months is a correction.
Okay, but you still think at $15.95, where you set your target there, you still think we're not going to get over $1,600 even in this short bounce?
I think we could bounce around and have it be a rocky road. So I'm talking about a short-term time frame, and I don't think it'll have an easy time going over that right now. If you want to talk 6 months or a year from now, I think it'll take that out easily. But right now, I think it'll be a bumpy road. It probably has some more room on the downside, probably about another $40 or so once it bounces higher. I do think it's going to bounce higher now, though.
You know, Jackie, I'm starting to view gold as the apple of commodities here. You know, it had its run, it had a nice shine, but investors are looking for another thing. Look at the numbers coming out of China. Look what happened with Foxconn yesterday, where they're scaling back things there. That gold goes into cell phones that are being produced. So not only in the investor side, but the industrial side, it's kind of losing its luster too.
Yeah, no,
so,
I think it's the opposite. I mean, two things are going to happen. People are going to find out that the recovery isn't real, that it's not as strong as people think, that it's all a function of spending more borrowed money. And as we get weaker economic data, we got a lot of weak economic data that came out today. Look at the Philly Fed. Look at the unemployment numbers, the housing numbers. Look what's going on with these home building stocks. They're now all rolling over. So I think this has just been wishful thinking that the economy is recovering, that the housing market is recovering. It's not. That's going to mean the Fed is going to be more aggressive in its monetary easing, not less aggressive. So we're going to get more QE. The economy isn't weak. I do think ultimately stocks will reverse and go back up, but not because the economy is improving, because the Fed is debasing the money at an even faster rate. So I like your trade. I think people should trade gold, but I think you should be careful. Maybe you can turn this short-term trade into a long-term position. Don't cut your losses short, because I think there's far more upside in gold right now than there is downside.
Jim, final word to you.
Grizz, just one question to Grizz. Okay, let's say the Fed threw out a trial balloon yesterday and started talking tough about QE. If risk assets start to deteriorate hard, particularly housing stocks and the overall stock market in the next week, there's another Fed speech next week. What if all of a sudden they start backing off that and going to join in the currency war? Is gold going to skyrocket?
Hey, Jim, they could back off of it, but I think they're at the point where they're not going to back off of it. And in fact, I don't see the point where they're going to actually add more of it, too, because we've had 4 or 5 years of this, and the economy is marginally improved, and a lot of people debate whether it's because of that or not. So I don't see them adding to the stimulus. I see them maybe subtracting stimulus down the road.
All right. A lot of different points of view. All